What is going on, guys? It is Jordan de Jong here, and today we're going to go over the Corelogics August 2020 report. I'm going to skip through a couple of the general screens here, like going through the specific states and everything like that. I just think I hound too much onto them, and these videos can get up to like 40 minutes long. So skip through to the good bits. Let's delve into the data and see what's going on. First and foremost, I hope you guys are all staying very safe. During the pandemic time. I know here in lockdown it's pretty full on and a pretty serious time, so whoever's in Melbourne, I hope you're staying safe. Wherever else you are in Australia, I hope you're staying safe, and hopefully the cases come down here and it doesn't happen anywhere else. But anyway, without further ado, let's delve in. Delving into the front screen here, not too much has changed. Is generally the way that we like to see it. We still like to see that outstanding mortgage debt at 1.85 trillion, but yeah, no major movements here. The quarterly change in national dwelling values was negative 1.6%, led by a negative 2% decline across the capital city markets. So yeah, seeing some pretty big hits here across the capital there. This is the quarterly change, so still up pretty positively year on year, but when we're taking a quarterly change, looking at the capital cities here, they're the big drivers. Melbourne declining by 3.2% and Sydney by 2.1%. Obviously heavier in the Melbourne section because we are going through that second lockdown now. Sentiment isn't as high, or consumer confidence isn't as high as it is in other cities, hence why, you know, there's pretty much a full-on lockdown going on as well. So no one's really getting out of the house, no one's really thinking about buying property, banks are tightening up, you know, there's all of these things that are contributing to these numbers. I'm actually surprised that they aren't higher than they are right now. Like, it's a pretty serious time, specifically with all of the different things that are going on. Obviously there's mortgage repayment deferrals and government stimulus coming in, the HomeKeeper, JobKeeper. But yeah, I mean, to be fair, you know, I'm completely surprised at how resilient the property market is, considering what we're going through. However, annual growth rates across most cities are still relatively strong off the back of the upswing in July 2019 and April 2020. Yep, so as we can see here, if we look at those same two markets being Melbourne and Sydney, you know, Melbourne's up 8.7% annually and Sydney's up 12.1% annually, which are huge numbers. You know, considering we're going through a massive pandemic, year on year, we're still up, we're still going strong. So still happy to see there. Since March, the upper quartile dwellings market values have been most affected by the pandemic, particularly across Sydney and Melbourne. So I was reading an article from Simon Presley the other day, who's big regional guy, but he's really got some good mindsets around property and how things work in different markets. And he's not, you know, just the traditional guy. A lot of people sort of give him a dig and hit him up because he's, you know, really pro-regional, and I'm open to all markets and all experiences. So, you know, I kind of take everyone's really good insights as a grain of salt and kind of pluck them where they are. And I can't remember the specifics he was saying, but essentially he was saying, like, you know, people in these larger properties that can't afford the mortgage repayments or can't afford the rent in the higher end properties are now moving into these lower cost properties. You know, same sort of thing, same 3-bedroom, just in a lower area or a lower costing area, or in a lower, you know, maybe a little bit smaller, maybe doesn't have a bigger backyard. Like, they're still able to live comfortably in these places, but obviously reducing their rent ridiculously, or their mortgage repayments ridiculously. And so what we're seeing is the higher end properties are actually losing value because there's more people moving out of them, there's less people renting them, there's more people putting them on the market, where the lower end properties are actually increasing in value. Well, not what we're seeing here, but technically they're not getting hit as hard because there's more people, there's more demand for those types of properties in a pandemic that we're seeing today. So yeah, as we can see with the Melbourne and Sydney markets here, and even the Perth market and even the Brisbane market, really, you know, the upper 75th percent quartile are getting hit harder, whereas these lower, you know, Sydney, the lower 25th percentile are negative 0.1%, so there's hardly any decline there. But essentially, yeah, that's what's happening across the major states. The ACT market is proving to be resilient amid the pandemic, with the third highest annual growth rate of the capital city regions. So ATC is strong there, obviously. That's where our capital is, that's where the government is, that's where Parliament is. Plenty of strong growth, jobs there, pretty essential services and all that sort of stuff. Not as hardly impacted by the pandemic, hasn't been locked down like Melbourne has for a second time or anything like that. So pretty solid market there, and I think we're sort of seeing that in the property results here. The 28-day rolling day home index is combined capital. So as we can see here, it's actually starting to slow down a little bit and had a bit of an uptick in the recent couple of months, recent couple of days. But I still think this will be on the decline or on the steady. I can't see it going into positive until the whole country's in some sort of non-lockdown state, and we're pursuing quite quickly. Melbourne is a major part of the GDP and a major part of the contributing to property market. Melbourne follows Sydney in that retrospect. So second biggest property economy. In complete lockdown, obviously we're going to see some slowing down there. The Corelogics Daily Home Value Index for the combined capital cities was negative 0.8% lower over the past 28 days to the 1st of August. The rate of decline seems to stabilise slightly in the past month, but the resurgence of the COVID-19 cases presents high uncertainty. Yeah, so essentially what I was saying there, I can't see it going crazily positive until we see some sort of break of the lockdown. I'm going to skip through these because it's generally quite simple. Sydney was down 2.1% for the quarter. Melbourne fell 3.2% for the quarter. Brisbane was negative 0.9%. Adelaide was increased 0.3%. Perth was negative 2.2%. Hobart was 0.9% increase. Dwellings fell by 1.6% in Darwin, and dwelling values were up 1.3% in the ACT. So strong growth there. Well, not strong growth there from the ACT, but some positive growth there from the ACT. Corelogics estimates that national settled sales have bounced back since April, since volume estimates increased a further 13.5% over July. So decade average there in that big bold line, and as you can see, the 6 months moving average nationally is coming back up again. Like that's really good to see. So the darker blue line is the 6 month moving average, but there's a big bounce back there, month on month, which is really good to see. Obviously, having a ban on auctions and all that sort of stuff had a massive impact on this initially, but it's good to see that we're bounced back and there's still people out there buying properties. Obviously, there's not as much supply on the market, and that's why, when we always talk about supply and demand in the property sector, there's still people out there that want to buy properties. There's still people out there that want to take advantage of this market. And because there's less supply on the market, that's why we haven't seen a major collapse as of yet, because there's still people selling, and for everyone selling, there's someone buying. So, obviously this is going to be a big impact moving forward over the next 3 years. Like, we're going to have to see how the economy kicks back up and how banks react to lending, and APRA moves in, and the cash rate, is that going to go negative? Not saying that it is, but it's not going to go up. They've guaranteed us that. What continual government spending are going to be coming in, what other home builder packages, stimulus packages are going to come through. There's a whole bunch of things that we're not sure of what's going to happen. So I think they'll do anything to keep the property market stable and keep it propped up until we get to the other side of this. Consumer confidence started to decline off the back of the resurgence of the COVID-19 cases, which is likely to dampen the sales volumes in the coming months. Yeah, so big kick down there when the first lockdown came through, then a general kick back up again once we sort of felt like we were a bit free again. Businesses were starting to open up, the economy was starting to open up again. Now that Melbourne is going through lockdown too, I think people are really starting to realise that this thing is real, and this thing can have a major impact, and if we're not careful, and if we don't lock straight away, and if we don't do the right thing, wear the masks and everything else, this can creep back into our economy and completely lock us down. So we need to hit it hard and fast, but it's still lingering around. I think that's the main point that I'm trying to get at here. the COVID-19 cases are still lingering around in the back of people's minds, and I think they're being more precautious about and more unsure about what is happening in the future, their job security, all that sort of stuff, moving depending on what sector they're in and all that sort of stuff. But yeah, how different the economy is going to be over the next couple of years. Annual growth in rent values fell to 0.6% and declined negative 0.7% since March. Rent values are expected to fall further in Melbourne amid the lockdown conditions. Yeah, so big sharp decrease there in rental values there, and obviously, you know, that's due to every you know, all the Airbnbs. No one's traveling, no one's doing, so all flood of all this stock onto the market. Heaps of unsurety, other people being able to get, you know, better places on a lower rent, and in that scenario beforehand where, you know, people are downgrading, the people that are paying really expensive high rent these days, you know, are taking advantage of this sort of rental space, and it feeds into itself where they're now getting out of those rental contracts and going into something more affordable, but, you know, might still be nice to live in. So bit of a decline there. It's nice to see we had a little bit of a kick back up here, sort of. I don't know, what is that? It might be sort of early Jan, but yeah, still a bit of a decline here. National dwelling values falls have so far been larger than rent value falls, which has led to slightly increased rental yields of 3 basis points. Yeah, so essentially the rental yield is how much rental return you're getting based on the purchase price of the property. So if purchase prices are falling and rents are falling but at a slower rate than purchase prices are, then that yield is actually getting higher because they're not falling as fast. They're coming down and that's not coming down as much. So you're still getting a higher yield for the properties that you're in, and that's a complete supply and demand thing there too. Median days on market increased to 49 days across the capital cities in 3 months to July, up from 42 days in June. Yeah, so that's a pretty big kick up there, you know, considering historically, if we're looking back to the 15th of July 2015, you know, there's not many big movements like that. There's one here sort of end of 2018, but yeah, that's a big days on market, and that's got to be the lockdown, the shutdowns. You know, there's properties that are going to, the unsureties, the consumer confidence. There's going to be more properties sitting on the market for a longer period of time because there's not as much happening. Supply and demand is still at the same level, but maybe people are taking longer to get loans approved. And, you know, I just refinanced 3 loans and they were the longest 3 loans that I've had to get approved before. One of the banks that I went with, Westpac, you know, they were doing all their stuff overseas in India and or in some country, I can't remember, but they told me when they went in, and you know, their whole back end was getting done overseas in different countries. And essentially when I was at the bank, they were saying, look, we're so delayed because the COVID cases over there, everyone's working from home, and they didn't have the facilities for their workers to work from home. They essentially had to be in the office or had to be wherever they were working from, with their computers and their printers, and to do all that sort of paperwork processing to get these loans pushed through, where, you know, they were all working from home, they couldn't go in, and none of the paperwork was getting done. So all of this massive backlog of, like, it was like, they said there were like 10 people in Australia or something. I don't know if it was 10 people, but there was like very limited people in Australia working on getting the loans through. So there was a big delay. And that might simply just be from that process. You know, people are trying to prolong settlements out, you know, not getting their pre-approvals done quickly. You know, there could be a whole case of things that are impacting these numbers here. On top of, you know, a big slowdown in the economy and a big slowdown in the market and a big, you know, shutdown in auctions and all the other stuff. So, you know, that was bound to happen in this sort of environment. However, the typical discount offered over the month eased from 3.6% in June to 3.5% across the capitals. These charts show median vendor discounting over 3-month rolling periods. Please note that the Corelogics have made significant improvements to the listings data, which help paint a more accurate and consistent picture to the real estate listing activity. These additions have resulted in revised view of historical vendor discounting series to ensure comparable across time. Very interesting. So they've actually fixed up their historical stuff and representing what's going on here. But yeah, interesting that there's an increase in vendor discounting. So more confidence there from sellers to get a better value for their property. At the 28 days ending of the 26th of July, new listings had climbed to be 1.1% higher than the equivalent period in 2019. Yeah, wow. So, New listings are now at the same level as they were in 2019. This was just after the federal election last year. So it's great to see that those listings are now the same. Obviously, this big lull down here generally happens in a seasonal retrospect between, April and May. There's a bit of a slowdown there, and that's, due to Easter and school holidays and all the other stuff that start to come through. However, there's a big decline because of the COVID environment, but now it's actually ticked back up to this sort of level, which is really good to see. Now this is going to be a really interesting chart to watch over the next, 12, 18 months. If people kind of start, investors have to start selling their properties because they're cash flow poor, can't afford to hold on to them, lost their job, whatever, rental tenants can't pay their rent, whatever the case may be, and having to list all their properties on the market. It's going to be interesting to see if this does get quite high, but obviously at a pretty stable level, pretty low level in relative comparison to, the prior years back into 2016. So be very interesting to watch this chart, but it is good to see that, there's some more confidence of listings coming on the market, and it hasn't peaked, dramatically right up. It's kind of stable there at that line. However, the sales volumes continue to recover. Listings were strongly absorbed and fell a further negative 4.3% over the month. Yeah, okay, cool. So sales volumes are still on the decline. Like, there's less sales happening, prone to happen in this sort of environment, but there's no rational dramatic drop there. Like, when you look at it year on year from 2019, there's a bit of a difference, but all of the prior years from 2016 have been following the same kind of trend. Obviously, there's a lot less lower than there is in prior years. There's like 100,000, maybe 50,000, 50 to 70,000 differences between 2019 and 2020, which is the gap is now closing into when we get into these later periods of the year. So bound to happen though. It's a slow economic environment. Capital cities are locked down. There's just not going to be as many sales happening as typically there are. New listings are now higher than the equivalent period last year across Sydney and Melbourne, Perth and the ACT. However, Melbourne is only market with a year-on-year rise in total listings. Yeah, so pretty interesting there. When we break it down to the state level, Melbourne is the only one with a year-on-year increase of total listings, which probably shows why they are leading the decline there. There's more people trying to sell their properties, more stock on the market, which means they are having to sell for more of a discount, or when there's more supply in the market and the same amount of demand, then the price has to come down. The typical clearance rate over July was 55.9%, down from 58.9% in June. So clearance rates had that massive shutdown due to the ban on auctions, bounced back up quite heavily to about 3,000. Highest it's been in the last 5 years is kind of like this sort of 4,000 level here, maybe a little bit above, with an 80% clearance rate. But now, we're heading back down to about 60% or 55% there, which is quite low. And traditionally it's been said when it's a lower than a 58% clearance rate, it's a seller's market, it's a buyer's market, and when it's above 62% or something like that, it's a seller's market. So it's kind of in that range, but now we're dropping down quite significantly, and also, we're going through a pandemic, so those sort of old analyses and old sayings and old perspectives on the market get completely thrown out the window in these sort of scenarios. We just don't know what's happening, what's going on, and how the market's reacting to this sort of activity. We can look at these numbers and we can see what's happening out there, but what they mean in relation to previously thought out standards or previously presumed clearance rate is completely different. What I do love at the moment too is Louis Christopher. He is he's really driving actual numbers and actual results. There's a lot of other companies out there that sort of report on auction clearance rates incorrectly, or aren't getting the right numbers from their real estate agents and all that sort of stuff. But he's kind of really he's doing his own analysis and getting his own auction clearance rate results, and then he's really pounding the people that are reporting incorrectly. And I think we're going to start to see that flow out into the data. I think that's super important, and it gives us a more realistic picture of what's actually happening out there in the market. So if you do watch the clearance rates, if you do take them as some sort of inspective of the market or indication of where the market's heading, I'd drop a follow on Christy Laufer or Christopher Lewis and follow what he's reporting in at SQM Research. It's phenomenal data over there. Good old Louis Christopher. The Melbourne clearance rate fell amid the second lockdown and a higher portion of withdrawn auctions, while the clearance rate stabilised at around 62%. So this is cool. This is a new chart putting Melbourne and Sydney against each other, probably breaking down the timeline here, which is really cool. First lockdowns, on-site auctions resume, which, is coming out of that ban. And then stage 3 lockdowns for Melbourne have really decreased significantly, where Sydney's kind of stabilised out at 61%, but Melbourne's down at 43%, which is, a pretty low number, in comparison. So that's really cool, actually, when you're looking at it at that level. It doesn't look like it's too bad or sort of resuming here when you're looking at, 55.9%, but when you can see that the bigger drivers in Melbourne at 43%, you can really start to see what's happening on an individual state level. The weaker clearance rates results stem from an increase in withdrawn properties as on-site auctions are once again suspended in Melbourne. Yeah, obviously, going through a second lockdown and you can't have on-site inspections and all that sort of stuff, that's going to happen. And we can see here, these are withdrawn auction. So this number's kicked back up again. I wonder, it'd be good to break this down into the Melbourne and Sydney level like they did the last one. That'd be really cool. But along with that, we can see that the percentage of properties sold prior is upticking again as well. So a lot of properties getting sold prior to auction, a lot of properties just being withdrawn from auction and going through private sale. So although properties aren't being sold in the traditional way that we do usually like to see them being sold in, or presume to see them being sold in, they are still getting sold, but just in a different format and a different landscape. Dwelling approvals declined a further 4.9% over June to 12,213, the lowest volume of approvals since July 2020. So big hit on approvals there. No one's really building. People are still building, but approvals aren't coming in at quite crazily as they were. It'd be interesting to break this down to like a unit and housing level, but maybe that might be they do. Housing is in units, yeah, so much bigger hit here on the units, much bigger decline in approvals there, which is really interesting to see. Housing still is coming down, but not being hit quite as much as units. Sorry, I was looking at this chart before and I thought the light blue and the dark blue were going to line up with this one, but this is May 20 and June 20. So yeah, as we can see, big drop there in all the ones. So Victoria's like only 7 difference, but New South Wales is like 500 different. So, the big drivers there is really New South Wales and Queensland. There's a whole lot of less units being approved in New South Wales and Queensland, which is really interesting to see. Monthly value of new finance commitments total taking a massive plunge there. Owner, occupier and investor on the first graph, plunging down there, which is really interesting to see. And that's because we're seeing less things being financed, really. There's less buildings being purchased. Portion of new lending for investment housing excluding refinances. Portion of new lending, yeah. So new lending is continually coming down here. Since May 16, really. It's just been continuously pumped. So a lot less investors out there. A lot less investors getting finance for their properties, which is pretty interesting to see. The value of finance secured for the purpose of housing saw its largest monthly decline in the history of the series since May 2020. Wow, in the history of the series, its largest decline. That's huge. Investor lending declined 15.6%, while owner-occupier fell 10.2%. The sharp drop in secured finance is likely a reflection of the stock to sales volumes in April. Yeah, when there's less things selling, there's less money getting borrowed. So obviously due to happen, but pretty interesting to see here that investors are taking a bigger hit than owner-occupiers. There's a 15.6% for investors and 10.2% for owner-occupiers. So investors taking a bigger decline there, but this sort of decline on a steep, steady hill going all the way down is very interesting to see. Through May, first home buyer participation as a portion of owner-occupiers fell sharply from April, but remains relatively high. First home buyers as a proportion of owner-occupiers commitments The cash rate target was held at 0.25% for August, though the RBA has reported the actual cash rate has been closer to 13 or 14 basis points since late April. So although they've held the cash rate there, there's still banks that are lending at a lower actual cash rate, and that's why we're still sort of seeing, interest rates from major banks starting to come down a little bit and continually come down, even though the cash rate hasn't changed. They're starting to come down a little bit there. But yeah, as I said before, there's no plans of increasing the cash rate until unemployment hits 4%. That's what the RBA has said, and hopefully that's what they stick to. If we'll go into negative territory, I don't know. We may, just depends how bad the pandemic goes and how much it gets hit and where the government stimulus stops realistically. Lending conditions were relatively unchanged from December 2019 to March 2020 quarter as economic conditions started to slow in Australia. So interest rates for new loans funded, weighted average variable rates and assessment rates. Essentially, this is the variable rates compared to the assessment rates. So even though when you apply for a loan, you'll only be paying in March 2020 3.1%, when you go to apply for that loan, you're getting assessed at 6.1%. So you have to be able to show that you can afford to repay that loan at 6.1%. And that's just a buffer for the banks to make sure that you actually can repay that loan in the worst case scenario if interest rates were to go up or something like that. So hence why it's a little bit different when you're thinking, I can afford, $1,000 a week in a mortgage. That's easy enough. That's all I'm going to be repaying. When essentially the bank is assessing you at 6.1%, which might be, $2,000. It's double. They might be making sure that you have to pay $2,000 back, and so your borrowing capacity gets limited because of that assessment rate. Portion of new loans funded on interest-only terms used to be 20.4% in June 2019. Now it's down to 18%, but up from December at 17.7%. So yeah, very interesting. Portion of new loans funded with LVRs less than 80% is 39.2%. So yeah, still a lower portion there of loans that are being funded on a lower than 80% LVR, which is pretty interesting. And that is it, guys. Thank you so much for tuning in today. I hope I didn't rush through it too quickly. I just didn't like these videos banging on for 40 minutes or anything like that. I just wanted to show you the good, decent graphs, show you what's changed, talk you through what they may mean, what's happening out there in the market, and get a deeper understanding of what's going on through them. I always recommend jumping in. These charts are for free. You can jump onto them at the Corelogics website, delve into them yourself, pause, look at them however you want to look at them, get a good understanding. But yeah, this is just my interpretation of what's happening out there at the guys. Obviously no professional advice or financial advice or anything like this. Everything in this video is just my opinion and general in nature, so only take it for a grain of salt, but do your own research and due diligence and understand what's actually happening out there. Get your feet on the ground, talk to agents, all that sort of stuff. As always, guys, keep safe. I hope you're looking after yourself in this time. Hopefully this lockdown in Melbourne sort of clears everything out and we can get the economy back up and running again. But until next time, happy house hunting.